The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome to Financial Planner. Over the next half an hour, we'll be focusing on why financial planning is important. And of course, the very seasonal subject that we'll be touching upon is income tax exemptions as we all rush to that deadline. Well, joining me in the studios today is with us Sumeet Vaid, founder and CEO of Freedom Financial Planners. Thanks a ton, Sumeet, for coming by to the studios. Sumeet, I think as the deadline approaches, everybody sort of starts going all over the place, wondering what does one need to do in order to get that exemption for income tax. Take us through the importance of this and why this should not be left to the last minute, and what are the various exemptions that are available to individuals like us.
So I think you started off on the right note by talking about deadline. And it's a very interesting thing when we see in our financial life. We are literally spending 70% of our waking up time earning our money. But when it comes to managing money, most of the times we leave it to the last time. And that's what deadline, especially tax saving in India, is all about. January to March quarter, most of the time, is one of the highest grossers for any kind of savings in India, whether it's postal savings, whether it's insurances, whether it's ELSS, etc. So that's something which one need to be very cautious about. And all our viewers who are watching us, I want to really tell you that failing to plan is planning to fail. And especially if you leave your things to the last minute, you'll always rush. And when you rush, the chances of you committing mistakes are very high. So keeping that in mind, let's try and analyze which can help you, save your tax much more better. So there are various sections which are available. Let's start off with Section 80C. It's the most popular one. You've heard a lot about it. We'll talk a little bit about it. Section 80C limit is 1 lakh rupees. That means there are various instruments which qualify for 80C. Okay. And if you invest in these instruments, you get a tax, savings of up to 1 lakh rupees. That means it doesn't get calculated as part of your income, and you get, help in terms of saving tax on that. The instruments which are applicable under it, Provident Fund, right. EPF, PPF both, life insurance premiums. Okay. Now, these life insurance premiums, I'm deliberately not calling them unit-linked insurance premiums. I want to do it separately. I think we always get into a trap of using word investing in insurance. No, that's wrong English. Always buy insurance. Do not invest in insurance. Distinguish between insurance and investments. Adequacy of insurance is much more relevant than getting higher return in insurances. So, life insurance premiums like term plans, etc. Equity-linked saving schemes of mutual funds. Now, these are equity-oriented schemes where there's a lock-in for 3 years. You invest and you get benefit under Section 80C. Now, again, I'll take a minute to explain about it.
Equity. All mutual funds are not ELSS?
No, okay, there has to be specific ELSS schemes. Okay. And most of the mutual fund houses run a specific ELSS schemes. Okay. But again, I'm highlighting the importance of equity in long-term wealth creation. Right. Most of the time, we have seen that, especially in India, the equity penetration among a common man's household like us is very, very low. And the reason is we somewhere get fearful of equity in terms of this volatility. Right. In this volatility lies the wealth creation opportunity. Right. Historically, it has been the best performing returns. And that's where ELSS scores very high because it's a closed-ended scheme. It forces you to stay invested. Right, and you have that patience also. So do look at ELSS scheme. Do look at equity. Just see what's happening to market right now. Just 4 months ago, everybody's view on market was so passive. Suddenly, everything is going in our favor. So don't worry about ups and downs. Stay put. You'll make good money. Let's move ahead. Then I'm talking about unit-linked insurance plans. Again, I'm highlighting it's separate. I'm deliberately keeping life insurance premiums and ULIPs separate because insurance is not to be confused with investments. Now, ULIPs are unit-linked insurance plans in which there is a little bit of insurance, a lot of investments bundled into it. Usually, the cost of this is slightly higher, so always be very cautious when you get into ULIP. But the premiums paid towards this also is applicable under Section 80C. Another interesting instrument, bank fixed deposit, which have of late been very, very popular in India because of interest rates going up. There is a 5-year bank fixed deposit or term deposit, which is 5-year plus, again applicable on 80C. Usually we don't advise our investors and Indian customers to really get into this because it's a locked-in kind of an instrument. Right, yes, you're getting tax break available, but I think there are better options which are available to really go in for that. But there is definite, for people who are really wedded to bank deposit, they can make something out of this. Then there's principal part of EMI on the housing loan. Housing loan is one of the better loans. There are two kinds of loans, good loan, bad loans. Housing loan and education loan is good loan. Don't really worry about it. Anything other than that is bad loan. Stay away from it. Right. But that also is applicable. Tuition fees is most ignored in India, but tuition fees is also an important element which can be used towards saving tax under ATC. And then NSC and various other postal saving instruments are also available towards ATC. So I think that's a very big one in terms of instrument. The most popular one where the bulk of your tax saving really happens and where bulk of the decision gets taken near the deadline, which is in January to March. And forget about February, March. I've seen it happening on February and March. In fact, one caution I want to give, we've seen a lot of people sitting on insurance policies like this. Every year they end up buying new insurances. Because their main aim is not buying an insurance. Yes, exemption. That's right. And without even going through the paper, they just sign. And it's really pathetic. We are really working very hard to make money. Please take care of money and start early rather than keeping it to last time.
Right. So Sumeet, when one decides which option or which instrument to go after, it's got to be very closely linked to the sort of goal they have in mind, right?
Very true.
Right. So obviously it's not one of those things that you scramble towards the last minute. I know it's difficult for a viewer to sit down now and decide on it. But this would obviously be very instrumental in planning the future.
Very, very true. In fact, what should happen ideally is right in the beginning of the year, financial year, let's say in month of April, you should do your financial planning first. Right. The guiding principle towards your investments or any such financial decision making should be your personalized financial plan. Sit with a certified financial planner, go through your financial plan, involve your family, articulate your goals, understand the risks on which you are, prepare a plan, and while choosing the instruments or the financial instruments which will help you live that financial plan, put tax saving as one of the filters. In fact, rather the first filter. Right. So I'm saving for my daughter's education 5 years down the line. I need to invest 70% in equity fund. Now, 70% of that equity fund can ideally go into equity-linked saving schemes, It gives me a double benefit of doing my financial plan and doing my tax saving also. Right, very, very important one. Usually we don't do it. A typical analogy will be, it's seen off late. Whenever we get a weekend or a long weekend, there's a clamor for us to going around and booking at the last minute. And we end up paying 100% more. Right. So somewhere, I have this interesting conflict which I want to articulate to all of us. We Indians are so conscious about saving money. Yeah. We are pathetic investors. We save very well. What is saving is income minus expenses. Okay, we'll do that. We'll cut our expenses. We'll save. We'll try and leave it for rainy day. But when it comes to investing, that means articulating it to goals, linking it to long terms, we really rush up. We really do something in Hindi which is known as bhed chal, listening to our friends and just getting to do it just because we need to do it. Wrong way of doing it. As I said, failing to plan is planning to fail. So
income tax savings should not be a goal. It should be part of the bigger picture.
Yeah.
Apart from that, apart from ATC, what are the other various sections available? Of course, ATCCF is your infra bonds, which we'll talk about in the next show.
That's right.
But what are the other important sections that viewers can look in?
There are many sections, which are not very popular on two counts. Before we dive into it, usually, the surplus, the common man surplus is around 1 lakh of rupees. Right. It gets covered in ATC, very, very efficiently in that. At the same point, there are sections available. If you will, do your financial planning, you can really articulate them and use them. So some of the sections which we need to talk about it, section ATCCD, which is contribution by employer towards pension. Right. So your chartered accountant will know about it. They will have to, of doing it. So that means filing of return is very important. Using professional help is very important. They'll help you articulate. Yes, you can do it on your own.
Just gets a little harder.
That's right. Section 80-day premium on health insurance, very important. Now again, one more point I need to articulate. Of late, the trend which we are seeing is most of the time in private sector, health insurances are given by the companies.
Absolutely.
All right. So this section, most of the people say it's not applicable. Whereas us as a financial planners usually go and tell families, that even if your corporate is going, have little bit on yourself. Because
in between jobs.
That's right. It's not very certain how long you're going to stay in a job. Or you might be in a situation like me. I left a very high paying job and started my own business. And suddenly I realized it's costly. If I would have started early,
it wouldn't be so bad. Okay.
That's right. So this is important.
That's another important one.
Then there are 80DD, which is medical expenses for disabled dependents. It's a very small group. Right. Then there is 80DDB, again specified illness oriented kind of a thing, which is there. Then there is 80E, which is education loan. Now this is important. Okay. There is an interesting trend emerging in India. Okay. Indians are saving more, and they are saving towards children's education. So that's good. That's productive. That's good for country. It's in terms of future side or future trends if you really go and talk about. But still, when we save, there is a huge emotional angle where we are, saying that I'm saving my money for my child's education. Whereas you should look at education loan. It's a good loan. Right. And encourage your child to repay that loan. Right. To repay that loan. I cannot and I should not sacrifice my retirement
for my son or my daughter's education.
That's right. And most of the time what families do, I will spend my money on my son's education, they'll take care of me of my retirement. And usually when they retire, son said, I never told you.
You assume that.
You assume that. So I think education loan is an important one to really focus on.
Okay.
Yep.
Right. Okay. So those are, of course, the key sections that you want to look at while you plan you'd rather plan your taxes, and of course exemptions are available, but don't leave this to the last minute. It's always good to get started and plan your goals, and of course income tax exemption becomes part of the bigger picture as well. So don't work with income tax exemption being your key goal. Well, on that note, we'll slip into a break, but when we come back, we'll take up all your financial planning related queries, so keep it with us.
The Financial Planner, presented by the Bombay Stock Exchange.
Welcome back. You're watching Financial Planner.
Investment Ladder, presented by the Bombay Stock Exchange. IPF.
We have the Sumeet Vaid in the studios who will be helping us answer all your financial planning related queries. Sumit, first up, we've got a query from Jaswinder Bindra who writes to us. He says he invests 5,000 rupees through an SIP every month, and he's looking to invest in the HDFC Top 200, which seems to be the most popular and highest rated, voted fund available. He says he wants to achieve 20% returns in the next 2 years. Is this doable? Is his 20% target in 2 years a realistic sort of target that he's got in mind? And in your opinion, is this HDFC Top 200 a good fund to invest in? Should he look at diversifying the 5,000 rupees? Should he put all his eggs in one basket? What should he do?
Okay, I'll start off with a very very typical instance and highlight one point. Let's say I'm planning to go on holidays. Okay, everything is packed. I'm ready to put my money and all. There's only one problem. I don't know where should I go. I think this question is like that. I'm doing SIP, very good. Please continue doing that. It's great. Then you say the amount is specified, fund is specified. The only thing missing is what is the goal and how long is that? When do I want to really achieve? First point which you want to articulate is please have a goal. Goals can be education goals, marriage goals, buying a house goals, or whatever it is. And define that goal in a specificity in terms of what is the amount, what date you want to do it, because that'll help you reach your destination much better. Coming to the fund choice which is there, I think HDFC Top 200 is a great fund. Why it is a great fund? Not because of the returns it has generated, I think because of the discipline which it has maintained in doing what it says it will really do. I think that's the quality of fund which need to really reflect upon it. So that's good fund, no doubt about it. But since you're doing 5,000 rupees, I think you should diversify. You should have an asset allocation mix. Right. It should be ideally 70% going into equity, 20% going into fixed income, 10% going into gold. Right. Should be diversified.
Sumit, but I'm just a little concerned because I don't know whether he wants to just stay invested for 2 years. Does he need the money after 2 years? So, we've talked about the fact that equity is a great instrument for the long term.
Yep.
But if you're looking at a 2-year time horizon, then debt might be a better option, right?
You see, that's where I started off. There has to be articulation of goal.
Right, okay? So if you're not aware of that, then it gets really difficult.
That's right. It needs to. It looks like to be a typical mistake which many of us do is that whenever we invest in equity, we have an expectation of fantabulous returns. Right. I want this much of return in this much of time. I think no one in the world knows how much an equity will really generate in what amount of time. Right. So one needs to really give it long term. 5 years is a good time if you're investing in equity. Anything less than that, you can be on the wrong side of the market. So give it 5 years, diversify. That means, your 70% goes into equity, should be into 2 funds. One is HDFC 200, Top 200, that's a good fund. Look at IDFC Premier Equity, that gives you mid-cap fund. Then look at 20% in fixed income or a debt fund. That's where Birla Sun Life Dynamic Bond Fund is a good fund, which is a good debt fund. And then 10% in gold, which can be any good gold fund of fund. Reliance has one, Kotak has one, which is a fund of fund where you can do SIP. That kind of a structure, time horizon 5 year plus, nothing less than that. But do remember, have a goal. You need to know what's your destination.
Right. Sumi, next up, we've got a query from somebody who's watching us quite regularly, I believe, and she says that she's a daughter of 3 years old and wants to invest 1.5 lakh for her lump sum. So please tell her what she should be looking to do. Should she be looking at a gold, mutual fund, equity, bank, PPF, and of course, how should she allocate this over lakh of rupees?
I think this question compared to last question at least has a direction.
Goal, right.
It's goal. It knows where they want to. One thing only which you need to add on is put a timeline. You have a goal, you have a defined, agenda that you need to say for your daughter. She's 3-year-old and you want to do 1.5 lakh rupees. I would love if you'll say, okay, 3-year-old daughter, I want to plan for her education. I'll need the money when she's 16. So, we'll know 13 years you have and you need to invest 1.5 lakh rupees. Now, coming to this 1.5 lakh rupees, what you should do, we should always remember asset allocation is the right way of doing any kind of investments over a longer period of time. Asset allocation means, I'm spreading my eggs, across asset classes. That means all my eggs are not in one basket. So it diversifies risk. It has been theoretically proven that 90% of your returns on portfolio happen because of asset allocation. So get your asset allocation right. In this case, the suggested asset allocation for you is put 70% in equity, 20% in fixed income, 10% in gold. This is the allocation. Under the 70% of equity, you should look at diversifying between large cap fund and mid cap fund. So there, at least 60% should go into large cap fund, HDFC top 200, DSP top 100. These can be good large cap funds. Rest money can go into mid cap fund like IDFC Premier Equity. There can be any other good performing mid cap fund which are available. ICICI Pro Discovery, which is a mid cap value kind of a fund. These are good mid-cap fund. So that's the equity portion. You're 20% in fixed income, put in Birla Sun Life Dynamic Bond Fund, one of the better funds, which is where fund manager is going to actively manage your debt portfolio and give you, as per the market returns, what is happening, and 10% into any of the gold fund of funds. So asset allocation is very, very important. Never miss that action, that putting all eggs in one basket is risky. So asset allocation helps you in giving that return.
Sumit, also she's looking at a lump sum sort of investment. Do you think an SIP would be a better option in order to, because you can't really, you want to make the best, make the best of all the ups and downs, right?
See, if you have a lump sum, then there are two options. Either I'll invest at one go, or I will time it out through systematic transfer plan. That means I'll put my money in liquid fund and try and do that. Having said that, for the goal, and I'm articulating goal for them. She said 3-year daughter, and I'm assuming it's for education, which is at the age of 16. There is 13 years. Now, if you have a 13-year time horizon, go in one go. Don't worry about it. If you got 3-4-year time horizon and you're looking at a bigger chunk of money, then systematic transfer plan really works for you because it averages out your entry points.
Right. That's the advice coming in for you. Sachin, they're pretty much highlighting what you really need to be doing in order to accumulate wealth for your daughter. We'll take a break on that note. When we come back, we'll continue taking up the financial planning related queries, so keep it with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. We have with us another query, Sumeet, coming in from a gentleman called Rahul, and he's pretty much given us his whole portfolio, and he's a long-term investor, so we know he's invested in for the next 5 to 7 years. He's given us the breakup of it: HDFC Top 200, HDFC Mid Cap, ICICI Prudential, HDFC MIP, DSP BlackRock, Franklin Templeton, DSP BlackRock Top 100, Canara Robeco Indigo, and income of debt instruments and gold fund growth of about 2,000 rupees, and IDFC Premier Equity. What are you making of the funds that he's invested in? On the face of it, this seems like too much to handle. There's too much diversification. Not sure whether that's a good thing or a bad thing, but what is it that you're making of it?
So, as we always say in our show, diversification is a good tool to really employ to have a good risk-adjusted return. At the same point, over-diversification is a very bad problem to be in, because when you over-diversify, you almost get into index kind of a situation, You've got so many funds which in terms are investing into different kind of styles, which in terms are capturing various kind of equity indices. So you're spread across too many, kind of securities, which is not good, because it then gives you a suboptimal kind of a return. So over-diversification is equally as much a problem as lower diversification. There are two extreme continents, and as you rightly said, this particular portfolio looks to be over diversified. Another point which we want to really highlight is it's missing the asset allocation game. Asset allocation is a very important thing to understand. Again, I'm reiterating, 90% of portfolio returns happen because of asset allocation and how long you stay with that asset allocation period. Most of the time we see that asset allocation goes for a toss while we're investing, because we'll focus more on equities, less on the other things, and it typically also resonates with our risk profile or risk style, which is there itself. So that's the second point. It's not asset allocated right way. It should be asset allocated right way. And if you're saying 5 to 6 years, then the suggested asset allocation will be 70% equity, 20% debt, 10% gold. All right. Now coming back to each and every specific scheme. HDFC Top 200, good scheme. Continue. All right. HDFC Mid Cap, again a good scheme. Continue. But also when you're investing, look at diversification at mutual fund houses level also.
As opposed to doing all HDFC.
That's right. You should have 3 to 4 fund families. So HDFC is one fund family. DSP BlackRock can be another fund family. Birla Sun Life can be another fund family. And you can look at IDFC as another fund family. Now, these are 4 fund families in which you have to go and create your portfolio, which is asset allocated in a certain way. So, ICICI Prudential, they have not mentioned any scheme name there. So, it's very difficult for us to really go and talk about it. Always be very, very clear yourself which scheme you are into, because ICICI Prudential has in excess of 20, 30 schemes in equity. I think overall they must be much more. So you need to really understand where it is. Having said that, off late ICICI Prudential schemes are really performing very well. Their Focus Blue Chip is doing well. Their Dynamic has done well in past. The Discovery is a good fund. So if we would have known, we would have really advised you. But do not be knee jerk with ICICI Prudential. I think it's a good fund if you got one of their mainline schemes into that. Then you have HDFC MIP. I don't know why you need to be in MIP. There's no positioning per se of MIP. I think you should exit out of MIPs, and MIPs over the last 3 years haven't really given a great return in terms of trying to do that. Positioning is debt plus, but somehow monthly income as a nomenclature is a wrong nomenclature to really get into HDFC MIP. So you can look at exiting that. DSP BlackRock Micro Cap. Now DSP BlackRock as a fund family is great fund, but you're going into a small cap fund. Now, small cap story is usually a long-term story, and this particular story will be very volatile. And will be kind of dependent on so many other factors. So if you really understand the scheme of things, then it's good to be there. Otherwise, I don't think so. You should get so specific when you choose fund. Get into a large cap or get into a large diversified fund. Let that fund manager take a call.
The experts take the
That's
diversification.
Right. What capitalization they need to go to. So you should move out of micro cap into one of the DSP top 100 kind of a fund or DSP BlackRock equity fund. These are good quality funds which can take little bit of small cap exposure. Franklin Templeton Blue Chip, it's one of the rock steady, good performing fund houses in India. You can continue to be here. DSP BlackRock Top 100, as we mentioned, is a good fund. In fact, your micro cap can come into this. You can exit out of this and come into this part. Can Robeco Indigo Fund? I really don't know much about it. So I will not be able to comment about it. But if I was you, I will give it a miss. I will try and come out of it and consolidate it into few fund families rather than being spread across various other places. Income from debt instruments and gold fund growth. So I'm assuming this is something like debt fund plus gold fund. Right. So Birla Sun Life Dynamic Fund is a good debt option. For gold, go in for any fund of fund which is available where SIPs can really go. Right. IDFC Premier Equity, great mid-cap fund. In fact, you also have a choice of BlackRock micro cap shifting into mid-cap, which is Premier Equity.
Okay, so it's between DSP BlackRock Top 100 or IDFC
That's
Premier
right.
Equity.
That's right. So consolidate. Do not over-diversify, have clarity in terms of asset allocation, 70% equity, 20% debt, 10% gold. Last but not the least, do get your goals right, because that's what your destination is all about.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Right, Rahul, hope you're listening. That's what you need to do. Do not over-diversify and get your asset allocation right, like Sumeet said. Well, that's all the time we have on this edition of Financial Planner. Thanks a ton for watching. Of course, tomorrow we'll be touching upon the importance of infrastructure bonds as well and what, of course, looks attractive in that space.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.